With the increase of inflation and the cost of living making things difficult for many people, it's no wonder that people are scaling back on investing. People are less focused on building wealth, and more focused on keeping the lights on and a roof over their heads. But what if I told you that you can build significant wealth with minimal investments? All it takes is a small seed of investing and regular contributions to turn it into a great portfolio. Let's explore how to do just that. Understanding the concept of compound interest. To begin building wealth, we require knowledge on how it's built from the ground up. The simplest yet most powerful way to build wealth is to harness the power of compound interest. You might be wondering what compound interest is. I do have a video on that, which I'll link up in the video here, but I'll explain it shortly here. Compound interest, in its simplest form, is the return gaining a return. A common way to explain it is to use a term deposit. Say you were to invest $1,000 in a term deposit that pays 5% compounded annually. On the first anniversary of your term deposit, you would receive $50 of interest. Instead of having that interest paid out to your checking account, the interest rolls over into the principal that you initially had. For year 2, your starting principal would then be $1,050, which would earn 5% for that second year. At the end of year 2, your interest return would be $52.50. As the interest rolls into the principal, your initial investment grows. Now, only $1,000 to start may not seem like a lot, but if you were to invest $1,000 each year and gain interest on each $1,000 each year, you can see how it can quickly pile up into a tidy sum of cash. That same principle can be applied to stocks as well. The nice thing with stocks is that you can continue to invest in the same stock, amplifying your total return. Let's take a look at Lloyds Banking Group plc, or LYG, on the stock market. As of the writing of this video, the stock is currently hovering around $3 per share, with a dividend yield of around 4.87%. If we were to take $100 per month, we can purchase 33 shares of LYG. Assuming the price and the dividend yield stay the same, and we consistently invest $1,200 a year for 10 years, with $10,900 of your own contributions, you'd have around $14,000. Not too shabby, considering we average $1,200 a year in contributions. If we extend that out to a 30-year time horizon, it would be worth around $80,000, with your own contributions only totaling $34,900. More than half of your balance is compounded returns. Pretty cool, eh? Now, this isn't endorsing LYG stock. This is merely for illustrative purposes. If you are curious about the stock, feel free to do your own research first before making any decisions. Also keep in mind that having a stock not increase or decrease in value, or having an unchanging dividend, is completely unrealistic, so don't expect these returns to be reflective of real life. Choosing the right investment vehicle. So, we've discussed stocks and term deposits as two ways to earn compounded returns. But what if you don't want to invest in either one of those? Maybe you don't want to have too much risk with just one stock, or you have a long time horizon and don't like the returns of a term deposit. Well, I'm glad to tell you that there are plenty of different options for you. A very popular method of investing is through mutual funds. If you haven't watched my video on mutual funds, basically what they are is a pool of funds from investors that a portfolio manager will manage. They do the hard work of researching and buying different stocks, bonds, and other assets. It's pretty hands-off for the investors, which make mutual funds very attractive for most people. Exchange-traded funds, or ETFs, work more or less the same as mutual funds, but you can buy them on the stock exchange, making them more accessible to regular investors. Don't trust portfolio managers? Or think the market can beat anyone? Maybe you don't want to pay higher fees on your investments. Index funds may be a good option to look into. Instead of having a portfolio manager research and buy different assets, they will simply park the funds in a pool that tracks the performance of an index. It's hands-off for almost everyone involved, resulting in lower fees, which can help bump up your returns. Don't feel comfortable with the stock market? Real estate investment trusts, or REITs, may be an option for you. Instead of looking at stocks, the fund manager will look into buying real estate and will pay out the rent and lease returns to the investors. There's little to no exposure in the market for REITs, which can make them an attractive option for investors that want to stay out of the stock market. Creating a sustainable investment plan. Now, all of these investment vehicles are great, but they may not be for you. Why? Well, each option has different returns available, different variations and risk levels, and different strategies. If you decide for term deposits, you've pretty much told your advisor that you can't handle risk. That may be either due to a shortened time horizon or a great fear of losing your principal investment. An investment in a mutual fund or an index fund may not be for you if you want to pick your own stocks and you think you can beat the market on a regular basis. A REIT may not be for you if you don't want exposure to real estate or aren't concerned with regular investment payments. What matters the most, though, before picking your investment vehicle is figuring out what you want to achieve, what your time horizon is, and what your risk tolerance is. If you have a short time horizon and you can't risk losing your principal, a term deposit may be what's best for you. If you don't want regular income and you want maximum growth over the course of, say, 40 years, most equity investment options would be a solid choice for you. It all comes down to what you want from your investments. If you need help, I offer an ebook on Gumroad that goes into detail on how to invest. Check it out in the description below. Consistent contribution and patience. Going back to our example with LYG, I mentioned that you should be investing on a regular basis. The reason for this is twofold. First, you'll want to increase the number of shares you own to increase your dividend dollar amount that you're getting. Second, when you invest regularly, you are hedging your investment against volatility. The market goes up and down on a daily basis. If you were to make a one-time lump sum contribution, you're putting your investment at risk by not mitigating against the volatility. If the market were to go down and you didn't regularly contribute, your investment would go down as well by the same percentage. If you invested on a consistent basis, your loss would be greatly reduced. As the share price goes down, you can actually buy more with the same dollar amount, reducing your average cost to purchase each share. Say you bought one share at $100. If the share price goes down to $50, you can buy 2 shares, and the average cost to you to have those 3 shares is $66 per share. If the share price goes back to $70, you would actually be up $4 per share, thanks to your second purchase. That, my friends, is how dollar cost averaging works. Now, you might think that if the market is going down and your investments are shrinking, it's time to pull the plug. That may not be what you want to do, though. You see, investing is a long-term game. You have to be patient before you can see results that you want to see. If you panic during downturns, you'll never see the upside of wealth building. You'll lose money and your sanity in the process. Trust that over time, your investments will rise. Don't make rash decisions on your investments if you see a drop in the market. Rather, see it as an opportunity to load up and buy your favorite stock, mutual fund, or REIT on a discount. As you might have seen, building wealth doesn't take a huge sum of money right off the bat. In fact, I'd argue that wealth starts with a little seed, and with some time, patience, and nurturing, it can grow into a portfolio that will last well beyond your lifetime. I hope you found this video encouraging and helpful. If you did, consider watching my video on how to invest when you don't have a ton of money. Thanks for watching, and I'll see you in the next one.